Hello everyone, welcome to this channel. My name is Ruben and today I want to give you an update on Dario Healthcare Corporation. The company is a pioneer in the global digital therapeutics market with a focus on chronic conditions. So let's have a look at their flagship product.
Dario understands that living with chronic conditions is hard, which is why we've made managing them simple and intuitive. The Dario journey encourages and supports healthy behaviors and fits easily into everyday life. For example, for diabetes, all a member needs is their smartphone and a pocket-sized all-in-one device. Anywhere they go, it takes just a few moments to get a glucose reading. But a reading alone isn't enough. That's why, if a reading is out of line, one-on-one support from a Dario coach is just a tap away. Chatting in the app is easy. And coaches are available over the phone, too. The Dario Engage platform makes coaching simple and effective. Coaches easily access member data in a variety of formats, enabling them to provide members with the best possible support. Healthy choices are made effortless through Dario's highly personalized and engaging experience. The app helps members understand how their choices are impacting their health, which makes the right thing to do the easy thing to do. Members stay motivated by seeing progress in the app on their glucose readings, habits, and activity levels. And rewards and gamification help encourage members toward healthy behaviors. And for an added sense of security, there's a geolocation feature for hypo events that can notify emergency contacts. Dario makes smart choices and healthy behaviors the path of least resistance.
So now you have an idea on what the company is doing. And let's have a look at the capital market summary. The stock is trading around $28 with a market capitalization of 227 million. The price to earnings ratio is not visible because the company is making a loss. We are talking about a microcap stock. And regarding the recent news, last month on January 27th, DarioHealth announced a acquisition of leading digital musculoskeletal company Upright Technologies for a financing of 70 million. So what are customers actually saying about this product? I wanted to compare that. If you look at Dario in the Google Play Store, you see that they have ratings around 4 to 5 stars. And if you compare that to a competitor such as Dexcom, they have 2 to 3 stars in their Google Play Store. So you can actually see that customers prefer Dario over Dexcom in this case. Let's compare the solution of Dario and Livongo. To me, it's clear that the Dario solution is much simpler and faster to use, while the Livongo solution requires a specialized device to test blood sugar. Dario solution can be used on a normal mobile phone, making the solution much more integrated into the person's life. The current total addressable market for this company is as follows. They make a distinction between metabolic with a US market opportunity of $72 billion. The second one is musculoskeletal with a market opportunity of 90 billion. Besides that, the company did research and they say that 140 million have a chronic condition in the United States and that the penetration of that is less than 1% at the moment. Dario solutions have also been validated by several clinical studies that have shown that Dario leads to improved patient outcomes and cost savings both ahead of Livongo. Now the most exciting part, which is that this company is very keen on mergers and acquisitions and buying out other companies to expand your business line. The company wants to transition from a direct-to-consumer model to a business-to-business-to-consumer market. Right now they have membership and devices with a ratio of 60-40. They want to change that to a 100% membership model to generate more revenue and also penetrate other markets. By expanding the pipeline, Dario wants to sell their products to health plans, employers and monitoring providers. They currently signed 24 clients and the additional pipeline revenue amounts to 500 million a year. And they also gain access to 2.4 million users. If you look at the product roadmap, they started in 2016 to 2018 with diabetes. In 2019, they added hypertension, and last month in 2021, they added a musculoskeletal company called Upright Technologies for 70 million. Before the acquisition, they had 69,000 users, and after the acquisition, they have approximately 159,000 users. And the ambition from the company is to buy out more companies. So we can summarize everything right now. One is that they want to expand the direct-to-consumer user base. Second, product enhancements. And three, scale via business-to-business clients. If they do that, they have the ambition to grow from $7 to $80 average revenue per user. In order to realize this expansion, the company hired a bunch of people. In the last conference call, they mentioned Eric Millich from Johnson & Johnson. Eric will work together with the scientific advisory board closely to help the company expand their portfolio into integration with CGMs. Secondly, Eric will also work with the team in order to generate data and clinical excellence that will help strengthen and achieve potential clients on the business-to-consumer channel. Here is some footage from the CEO admitting that he wants to be an acquisition target in the telehealth industry.
I don't want to get too specific, but if another larger company came in and wanted to swallow you up, would you go for that?
Yeah, so I think that we built a very, very compelling solution, and we have more than 50,000 active users that are happy. Actually, we are top rated in the App Store, and our Net Promoter Score is 77. So I think that we did a very good job by creating a good solution that's showing that we can improve outcome and we can save a lot of money to the healthcare and get happy users. And, it's yet to be seen what are the offers that we're going to have, but we feel that we are in a very good spot, growing and creating a market share here in the US.
Here is an overview of insider buying. You can see that the CEO as well as the director have been buying shares recently. Normally, if executives are buying shares, this is a very good sign of the company. Maybe they know some secret information. Let's have a look at the income statement. In the last quarter, the company spent 3.6 million on sales and marketing. They generated an operating loss of 6.6 million. This increase in the operating loss was expected, at least they told that in a conference call, because the company is trying to establish an overall operation in the United States right now, specifically building an overall sales team. The cash flow statement, the biggest adjustment for operating activities is the reconciliation for stock-based compensation in the 9 months ended in 2020. If you look at the financing activities, you can observe that the company did a 27.5 million stock offering to finance their growth. Regarding the balance sheet, the total current assets for the 9 months ended in 2020 are 39.8 million and the total current liabilities are 5.8 million. Now that we know that, we can calculate the current ratio. The current ratio is a liquidity ratio that measures the company's ability to pay short-term obligations or those due within 1 year. You can calculate the current ratio as follows. You take the current assets and you divide that by the current liabilities. In this case, we get 6.8. The higher the current ratio, the more likely the company is able to pay its short-term debt. Normally, you want to have a current ratio of 2, but in this case, the company is making loss, and it's very desirable to have a higher current ratio. Looking at the non-current asset side of the balance sheet, we can observe that the company, for the 9 months ended in 2020, that they spent most of their money on operating lease and property, plant and equipment. So here are the opportunities and risks. What I like the most about this company is the insider buying by directors and CEO. You are literally putting your money where your mouth is. I like that the company is also open for a buyout. I like that they have growth expansion plans with more revenue potential and higher gross margins. Dario also seems to be legitimate. They have better app ratings compared to competitors. The solutions have been validated by several clinical studies. However, if you look at the risks, the company is currently making a loss, and from my point of view, it's all about execution. Like, can they deliver? And if they can deliver, I might take a position in this company. Alright everyone, this was the analysis. Thank you very much for watching and see you on the next video.